And it's the first trading day for this week. Hello and welcome to Business Morning right here on Channels Television, live from Lagos, where we bring you markets to your screen and the economy into sharp focus. Let's start off now with what's playing out with major markets, starting with oil. Now, we've seen oil futures, they jumped more than 2% at the start of the first trading session since the U.S. Launched direct attacks against Iran, casting a shadow over the supply outlook in the embattled oil-rich Middle Eastern region. And we see the impact there on prices, 0.70% up. That's for Brent crude, $77.55 a barrel, a big, about $1.76 jump there. WTI crude down 0.70%, same margin there, $74.35 a barrel. You see both benchmarks there did rise over 2% for the week last week. And we see President Donald Trump on Saturday surprised markets with the announcement that Washington had directly entered the Iran-Israel conflict, launching attacks against 3 Iranian nuclear sites in Fordo, Natanz, and Isfahan. So definitely we're seeing the impact there, even in other asset classes at this point. We'll keep tracking all of that action for you. To other stories now. In 2024, Nigerians conducted a staggering 223.27 trillion naira worth of transactions, and that was via POS, that's point of sale terminals, more than double the 110.35 trillion recorded in 2023. And that's according to the central bank's Nigeria's quarterly statistical bulletin. The total number of POS transactions that rose from 9.85 billion in 2023 to 13.08 billion naira in 2024. That's about a 32% increase year on year. In contrast, ATM transaction volume, that remained largely flat, rising marginally from 1.01 billion naira to 1.022 billion naira transactions. The value of ATM withdrawals in 2024, that was about 29 trillion, a slight increase from the 28.21 trillion in the previous year, further confirming a slowdown in cash withdrawal growth relative to digital payment usage. Monthly data from the Apex Bank shows a consistent rise in POS transaction values throughout 2024. All right, to other matters now. The Securities and Exchange Commission, they've unveiled a significant corporate governance reform, mandating a 3-year cooling-off period before a serving CEO can assume the position of chairman at the same public company or within the same corporate group. The directive, issued via circular to all public companies and capital market operators, also prohibits independent, non-executive directors from moving into executive roles. It introduces tenure caps, about 10 years for CEOs and 12 within a group, as well as a 4-year limit for former CEOs transitioning into chairman roles. The measure, effective immediately, aims to reinforce board independence, prevents power consolidation, and elevates oversight standards in Nigeria's capital markets. Meanwhile, we're already getting reactions to that. Analysts believe the move aligns with a growing global push for stricter board governance and a clearer separation between oversight and management functions. Managing Director and Chief Executive Officers of Arthur Stephen Asset Management, Mr. Latunde Omalagbe, said the development was expected. According to him, as the circular said, it is just seeking to enforce codes that are already in the statute, which should not be surprising. He emphasized the importance of sustainability in corporate leadership, adding the critical issues to ensure significant players in the market have solid succession planning and ensure that their businesses operate in a sustainable way for the benefit of all stakeholders, particularly the public that rely on their services. And we see Stanbic IBTC Bank officially unveiled its newly revamped private banking proposition designed to offer high net worth individuals bespoke financial solutions. The occasion also featured the grand prize presentation of the bank's Save and Enjoy promo, rewarding customers who demonstrated financial discipline with travel opportunities and other exciting prizes. Take a listen.
Platform. It's an evening of celebration and reward as select esteemed clients and customers of Stanbic IBTC Bank gather for a special occasion in Lagos. This is the institution's private banking media parlay, which also doubles as the maiden edition of the Save and Enjoy promo grand prize presentation.
The private banking suite has put together this reward and loyalty event to recognize our clients. It's also our opportunity to reaffirm our commitment to offering you valuable, enriching, wholesome services that enable you, not only create wealth, but sustain that wealth, and you are able to transfer that wealth as a legacy to your loved ones.
Stanbic IBTC has rebranded its affluent banking segment to Stanbic IBTC Private Bank, a move designed to offer high net worth individuals a more bespoke, premium experience.
This is not just a name change, but a reflection of our commitment to delivering superior, tailored banking experience that meets our customers right at the heart of where they want us to be. In our mission to redefine private banking in Nigeria, we have carefully redesigned our services to deliver a more personalized, secure, and exceptional experience tailored to our top customers in the bank.
With a focus on customized banking, wealth advisory, and tailored investment solutions, clients enrolling in the Stanbic IBTC Private Bank proposition gain access to a suite of exclusive financial and lifestyle benefits that go beyond traditional banking.
We ensure that we help them to sustain their wealth by investing, acquiring additional wealth and doing other financial things that will help them to move their wealth to the next generation.
The event also features the grand prize presentation for winners of the Save and Enjoy promo, where 4 private banking clients were rewarded with open business class flights tickets to the UK, the USA, or Canada. Other winners also walked away with exciting prizes, including 5 one-year priority pass access to over 900 lounges and 32 vintage boxes as a reward for their loyalty.
All right, now to our first conversation. We see microfinance institutions as MFIs play a pivotal role in empowering Nigeria's vast informal sector, which according to some estimates contributes up to 65% of GDP and employs over 80% of the workforce by offering collateral-free credit, flexible repayment plans, and tailored financial tools. MFIs bridge the gap left by traditional banks, particularly for women entrepreneurs and small informal businesses. Well, joining us to unpack the industry now is Seyi Ashagu, is the CEO, Entourage Integrated Trust Limited, and also a finance expert. Joining me right here in the studio. It's great to have you. Good morning.
Thank you. Nice to be here. Thank you
it's
so
great
much.
to have you. So, at the end of the day, we know private sector, at this point, we're looking for credit and affordable credit, for that matter. We see the CBN is trying to battle sky high, inflation. We've seen interest rates stay elevated. So definitely that makes it quite difficult to get affordable credit, in this kind of economy. But before we go into that, geopolitics is on the front burner right now. We're seeing what's playing out in the Middle East. And I don't know if you're seeing any risk for your sector with what's playing out so far.
Yeah, I mean, I would look at, let's even start from the commodities. People who actually will sell goods and services, prices will start going up. A little bit of inflation, and then that might drive up lending rates at the moment. So I think that's the reason that's going to be prevalent.
Right, and definitely, I know businesses don't want to hear that.
Yeah, we don't want to. We certainly don't want to.
At this point, because we're already hearing calls for interest rates to be reduced. At this time.
Most likely, this war and what's going on will probably jack up interest rate.
Right.
At the moment.
Right,
so,
and definitely, because it's a no-brainer at this point. We're already seeing what's playing out with oil prices. Oil prices going up.
Oil prices will certainly
That's
go
a
up.
risk for inflation.
I think Dangote just announced some jack up in their prices, and so that's what we'll start seeing. As soon as if this war goes on more than this, then price of services, commodities, and importation, everything's going to go up. So we just have to pray that this
Right, I already saw some concerns this morning, talks about fuel prices, the risk of fuel prices even going higher at this point. We know how much of a driver of inflation, that is. But let's come down to the MFIs, at this point. Talk to me about what you're seeing when it comes to the MFI's position in funding the informal sector. Are you seeing any improvement, so far?
I wouldn't say I'm seeing improvements because, one, we need to look at the statistics to start with. These informal sectors account for more than 50% of our GDP. And we're talking about a sector that provides more than 84% of the workforce. And we have over 40 million of these informal businesses. But guess what? Only about 4% of this sector, of these informal businesses, are able to even access funding from banks. This is what you call grossly underserved. These people are they are basically the one carrying the economy, but we don't provide funding for them. So I don't think MFIs are doing so much. But what is the role of MFI in all this? MFIs are supposed to provide basic funding, bridge financial gap, help with economic mobility from one stratum to the other, from micro to small and to medium. But at this rate, what we're seeing is microfinance institutions behaving like banks themselves because they do not understand the kind of structure, the accountability structure that these informal sectors have. They're looking at them like they should be acting like large corporations, they should have financials, they should have collaterals. They don't have it. So how do you attend to these people without unnecessarily giving them the burden of go look for collateral, go get the kind of things you will ask, requirements you ask from large corporations to be able to avail them credit. So we are saying that microfinance should understand the accountability structure, which is essentially trust-based. They don't understand it, and they don't have boot on ground. We still don't have boot on ground.
But how hard is it to, get trust, when it comes to, the MFIs and the informal sector? Because, being informal almost makes it, seem hard, to get data on, such businesses.
So I'll tell you something. At the micro level, you find out that if you have two people who sell, one sells okra, the other one sells beans. They've been in that same Oshodi market, for example, for 20 years. So you just need to understand that they relate based on trust. Have you ever been to to buy goods from one of our Igbo brothers? If they don't have that good you want at that moment, they will run quickly to one of their neighbors and they say, oh, Chinedu, quickly give me this good. I have a customer.
Oh, yeah, they do that a lot. Yeah.
Right. So when they don't have to start signing documents or saying, okay, you need, that's more like you're giving the person credit. They don't get to sign for anything. They get those goods. And when they attend to their customer, they sell, they make a sale, they go back. And, of course, they sort themselves out. So we're saying that the kind of requirements that we should be looking at for funding should be trust-based, in the sense that they should be able to guarantee one another to say, okay, I know Chinedu. He's been here for 20 years. He's going to come back here tomorrow. I know Mama Tawa, for example. She's going to come back here tomorrow. Okay? They've been there for a long time, and they need to, microfinance institutions need to understand how this works. Because if you're waiting for Chinedu to give you collateral, or you're telling him to come do some form of savings before he's able to get funding, then you're asking for too much. He doesn't even have the inventory in the first place. That's why he's coming to want to obtain some credit to either scale or improve on his inventory.
All right, and you did mention the okra seller and most of the food sellers.
These are the micro guys.
The micro guys.
So they are the ones that carry this economy.
Exactly, and definitely we're dealing with elevated prices of almost everything. At this point, we're hearing people having to buy a bunch of plantain for about 5,000 naira, which I remember at some point it was like 800 naira to get that. So we're seeing food inflation at its peak. If the MFIs play that role well that you talk about, do you think that could help in bringing down food prices?
Certainly, because you will also look at the interest rate. when microfinance institutions don't play their part, you will see these informal business sector guys go borrow at ridiculous rate, sometimes as much as 20%. 20, I'm not saying per annum right now, 20% flat a month. That's high. That's certainly going to, I mean, if Chinedu, for example, borrows at 20%, he's going to have to spread that on whoever is coming to buy. So we need to keep the interest rate at reasonable and competitive level, such that it won't further drive up inflation. We have a lot of stuff going on right now. We don't want to further drive up inflation, but we need to make the MFIs do their bit.
And when we look at regulation, definitely we'll see this segment is also regulated. How do you think the regulation currently in Nigeria, how do you think that's playing into how the MFIs operate?
Because, you see, we're beginning to regulate MFIs like they are conventional banks or commercial banks. They can't play by the same set of rules. So MFIs are basically supposed to be like your local government, okay? And we should not have too much expectations. The people that they lend to are not large corporations. It is with large corporations that you would be looking for collateral, you would be looking for financials and checking their statements. These guys don't have financials. They don't have statements. So you cannot, the rules that govern, the regulations and policies that govern commercial banks cannot be the same set of rules that govern microfinance institutions. Microfinance institutions, as far as I'm concerned, should operate, like I said, as they should check for what these guys are doing and understand their accountability structure first. And whatever set of rules we're going to be putting in place for them should be trust-based, such that you can get them in that community or wherever you're dealing with. If you're dealing with them in like a market system, you should get them to guarantee one another, to say, I know Chinedu. Chinedu knows Godwin. Godwin is going to guarantee Chinedu. Chinedu is going to guarantee Godwin. That tells you that there can be peer pressure if they don't pay. To say that if this guy don't pay, you easily can go to Chinedu and say, Chinedu, Godwin isn't paying he's not paying his credit that was availed to him. And then he somehow makes him to pay. That is the kind of accountability structure we should be looking at. Really
so it's possible that trust is not a risk in that segment?
It is a risk, but it's a risk that can be mitigated because these guys know themselves all too well. They've been in the same community for decades sometimes. Do you understand? So, and let's look at it from where this all started, or from like the Grameen Bank. It's all trust-based. This group of women, they know themselves. They don't need collateral, and in some cases, in most cases, they don't need savings. Because if you're telling someone, come bring savings, bring your own share, because what we're trying to do most times is to say that you bring your savings before you can get collateral. Are we doing income redistribution here? These people don't have these funds, and that's why they're coming to come and borrow in the first place. So we shouldn't set rules and regulations that would make them be the underserved that they already are, or further deepen that kind of name that we have decided to give to them.
Okay, so looking at the MFIs at this point, what kind of innovation or trends are you seeing in 2025 so far, or do you expect to see going forward?
Well, the innovation I will expect to see, I'm not a fan of. See, innovation is good, especially when it comes to technology, but I still maintain that if we want to see MFIs lend to businesses, we should be talking about having boots on the ground. These are people that microfinance institutions should be able to put boots on the ground for them to be able to understand the accountability structure of these informal sectors. And it's only then can you be innovative when it comes to your pricing. Can you be innovative when it comes to even the amount that you offer them? Because if you don't understand them, if you're looking at them acting like they're like large corporations, then that won't happen. What you need to do is to understand how they function. only then can you be innovative in your lending, in what your requirements are going to be. Then, I mean, maybe when we have help with that economic mobility from micro to small and to large, we can start introducing some form of technology that will help them with their banking transaction, because most of these people we're talking about are actually not people who are learned.
Right. So definitely a lot to unpack there, and definitely we're hoping for a time where we see the little guy who's getting as much credit, as he needs to become the big guy, at some point. That's what we're looking for. Thank you so much. It was great having this conversation with you, Mr. Asheyi Ashagu, who's the CEO, Entourage Integrated Trust Limited, and finance expert. Thank you for coming on today.
Thank you so much. I appreciate it.
All right, I'll take a break now. When we come back, we'll find out what's playing out in the digital lending space in Nigeria and what to expect for the global economy this week. That's a moment. Just stay with us. Welcome back. Well, digital lending in Nigeria has rapidly expanded with over 200 platforms, including fintech startups, Chinese-backed apps, and traditional banks offering fast, collateral-free credit via mobile apps. But this rapid growth has surfaced some serious regulatory, operational, and consumer issues. We also see regulatory gaps, enabling predatory lending, high interest, hidden fees, and abusive recovery tactics, prompting the FCCPC and the CBN to enact interim guidelines and crack down on illegal players. Well, join us to unpack this now. We have Oluwatoyin Olaoye, is the Chief Risk Officer to Vendor Credit, joining me via Zoom. Great to have you on the show. Good morning.
Good morning, Larry. Great to be on the show.
So let's look at regulation now. How well do the existing frameworks, we've seen coming from the CBN and the FCCPC, they're trying to streamline, digital lending guidelines. How to address all those predatory behaviors and consumer privacy abuses, in your view?
Well, thanks for that, first of all. So what we've seen basically over the last couple of years is that there has been a lot happening in that digital space, right? And there still remains a gap between policy and enforcement, right? So while, like you rightly pointed out, we introduced the limited interim regulatory framework to rein in predatory lending, many digital lenders still operate in gray areas. And I think this sort of speaks to the fact that I think from a regulatory perspective, there's still a lot that needs to be done on understanding the digital lending space and putting the right policies in place to ensure that this doesn't happen. And also on the other end, to ensure that digital lenders are not allowed to operate in gray areas where there's no clear sign of policy, so that things like predatory lending can be nicked in the knob, right? So you have a situation where that gap exists between policy and enforcement, and so a lot of this is still ongoing in Nigeria.
So, where do you see jurisdictional overlaps? We have the CBN, we have the FCCPC, NCC, NITDA. Do this create confusion? And how do you think you can coordinate these different regulators there to have improved regulation?
So in situations like that, what I have done and what we have done personally at Vendor Credit that has worked for us is to ensure that you have a robust compliance team in place that understands the regulatory policy for each that has been issued by each of these regulatory bodies. So if it's from either the FCCPC, the SEC, or the CBN, right? You need to ensure that your team understands each policy and has a robust conversation with the regulators at all times, right? So, and what this does for you is that that engagement sort of allows knowledge to be passed across board. So in terms of, staying on the fine line of regulation, you are not caught out entirely, and you understand what the requirements from each of these guys are. And so in situations where you even have overlaps, right, you can speak to it and say, you've had discussions or you've adhered to certain rules that have been provided by the SEC, and even push back in some cases and say, oh no, this is not covered by this, what you guys are doing. We've already, aligned ourselves, or we've already adhered to it, obviously because this policy or this circular has been issued by another body. So you need to have a robust engagement with each of these bodies at every point in time to ensure that you are compliant on those fronts.
Right, and mostly digital lending, that happens mostly over the internet. Talk to me about some of the top cyber risks, faced by, the digital lenders. At this point, we know there's phishing, there's DDoS, internal fraud. How are they, navigating all of this?
So one of the top risks could be cybersecurity, right? Cyber criminals are getting more sophisticated. In Nigeria, as at the last data that we had, I think, about between 3,000 to 5,000 cybersecurity experts, and that's just a fraction of the amounts that you actually need to nip this in the bud. And so for a lot of digital lenders, right, cybersecurity continues to be a challenge. I say this because a lot of lenders are also heavily reliant on third-party infrastructure, right? So if it is your cloud services, your KYC tools, for people who have outsourced their credit scoring to third parties, right? And so what this introduces is a lot of operational risk, particularly when you have downtimes or when data leaks occur. And so for us, it's a major concern. And once data is leaked, it erodes trust, reputational risk comes into play, and then data breaches itself can be devastating. And so what we've done basically to tackle all of this is to ensure that your IT and your risk teams are constantly speaking to each other, are constantly aware of what is going on in the space, right? Ensure that you have a robust multi-layered security architecture, right? Right from origination to disbursement to KYC. Ensure that at every point in time, you have people who are looking at it from both sides, right? You have a make and checker system in place. Your IT team and your enterprise risk teams are constantly communicating, and then ensuring that you implement strict vendor risk management for third parties, right? Policies in place to ensure that whoever is going to be providing a service that you yourself cannot provide, right, has the right cybersecurity protocols in place, right? And then you also need to continue training employees. At our organization, we do a random phishing exercise just to ensure that our guys understand the risk when they open, malicious emails with, dodgy email addresses or attachments. And so continuous training for your employees is very key, ensuring that both your IT and risk teams understand the risk and appropriately trained and are constantly aligned on what needs to be done.
Right, and talking about being always updated, at this point, do you think it's getting harder to protect, consumer data, with these digital lenders? And do you think that, we can get to a point where the security is so robust that, most of the consumers there are not afraid to give out their data to some of these lenders?
Yeah, I think we'll get to a point where security protocols will become robust. You cannot eliminate the risk of leakages or cybersecurity criminals trying to get information. What you can do is minimize it to the barest minimum, right? And by so doing, ensuring that you have a robust security infrastructure in place also tends to enable trust. So in situations where you constantly, and I've also seen that what also helps is communication. So communication to both your stakeholders, internal and external, your customers, letting them know that they also bear a responsibility when they put their details online, but also ensuring that whatever details are stored with you are stored to the utmost security protocol to ensure that there are no leakages. I do believe that we'll get to the point where you have robust protocols in place that will minimize the risk, but not totally eliminate it.
Talking about most of the digital lenders in the space now, do you think the market is oversaturated, or we have the right amount of digital lenders in the market?
Oversaturation. I think what you have right now in Nigeria is a lot of players who are offering the same thing, right, without a lot of differentiation. So it goes by different names, payday loans, salary advance, whatever you want to call it. But all of it is linked to something, right? An employee who has a steady cash flow at the end of every month that you can make a credit decision of, right? And by so doing, you've left out an entirety of the market, right? So there are people who supply vendors, for example, who supply goods needed for the completion of a service, right? You've not captured that there is the whole informal sector who make their money from buying and selling that are not appropriately captured. So it's not really a question of oversaturation, it's a question of the lack of differentiation, right? And what has happened is that, so you have so many people who have seen that there's an opportunity of some sort in that space and are chasing the same thing, and has led to this explosion of digital lenders. But what we do need to have in place is lenders who understand the marketplace and who come out with, products that can address the lack of credits, right? You can't go to a market woman and tell her that you are offering her a salary advance loan if you don't understand her business, if you don't understand supply chain, if you don't understand her buying and selling. Same thing for somebody who, and I'll use the coastal road, for example, as a loose example, right? Who is probably supplying, sand or gravel that is needed to ensure that that road sees the light of day, right? You need a product that's, meets its needs at every point in time. And so I think that's where the issue is. So not so much an oversaturation, but so many players who are sort of doing the same thing with a lack of differentiation.
Right. All right, let's look at some of the risks there, because I know you love to deal with or identify, some of the risk in your industry there. We still have the macros here, inflation, currency weakness, and we have the tension in the Middle East right now. So what risks are you seeing for that segment, so far?
So recent events in the Middle East, I think for us as a whole, I think we'll be able to dimension the risk properly based on the response from the other party, Iran, right? We've seen the US and Israel play their hand. And so what you're seeing right now is just people are slowly reacting to what happened over the weekend. I think a lot of it is also dependent on the response from Iran, right? Nigeria's benchmark for crude oil is $75. We've seen it tick up slightly to 78 over the weekend. Reports are saying that it would most likely get to 80. But like I said, all of this is also based on the response from Iran, and then that will determine, on the end. Obviously, there's a sovereign benefits. Higher oil prices leads to higher revenues for Nigeria as a whole, as a sovereign. But higher oil prices, since subsidy has effectively been removed, leads to increased petroleum prices. And what happens then is a shrinking of disposable income. And then you have also the risk of inflation, because once petrol price goes up in Nigeria, every other thing, follows suit. And then you now have to deal with that on a singular basis as is, right? So that risk exists, right? There's also the systemic risk that we have a whole, right? The digital lending space, where I believe that most lenders need to embed flexibility in their models, right? Dynamic interest rates, grace periods, because with whatever is happening in macro has a significant impact on whatever you're doing as a business. And so you need makers to assist with stabilization tools. A lot of lenders right now do not appropriately or cannot appropriately ring fence their financing because of lack of things like guarantees or credit risk insurance. And that speaks to a whole different issue entirely, where because of where we are as digital lenders or in the economic space, our insurance products are not as sophisticated as we need them to be able to cater for some risk. But that's a whole different conversation on one side. And so these are just a couple of things that we're noticing that going through, and hopefully, like I said, a lot of it is also dependent on what happens in the next couple of days with regards to the response of what happened over the weekend.
Right, definitely a risk there. We have to find a way to mitigate those risks. Thank you so much. It was great having your perspective. Oluwatoyin Olaoye is the Chief Risk Officer at Vendor Credits. Thank you for coming on today.
Thank you for having me, Ladi.
All right, let's look at other matters now. We see Nigeria stands at a pivotal crossroads where sustainability and ESG, that's environmental, social, and governance practices, are not just ethical imperatives, but powerful engines for innovation, investment, and long-term growth. As Africa's largest economy, Nigeria is increasingly aligning with global ESG trends there. Joining us to unpack this, we have Dr. Chizo Malizes, who's the MD CEO, FITC, joining me right here in the studio. It's great to have you. Good morning.
Good morning to you.
So, definitely a lot is happening, right now, and we know we would love to see companies comply more with ESG, but there's a lot of tension, right now. Looking at what's happening, in the Middle East, so far. How much of a risk, or how does geopolitics, impact companies' ability to actually comply, with ESG? Does it make it harder for companies?
Of course, it does make it harder. First of all, there is the need for stability everywhere in the world. And then when there are crises, there is also a lot of threats. So when we speak about those crises, automatically it impacts the environment. It impacts businesses. It impacts SMEs, innovation, growth. And so all of those disruptions are definitely going to erode the intentions and objectives of ESG. And so stability is important. We need to create the stability. And so whether it's globally or in our local environment.
Right. And what steps do you think companies should take, at this time? We're hoping things don't escalate, at this point with the tensions we're seeing so far. But if it does, how can a company still, position itself to comply for ESG? So
for every organization, the start point is to ensure that we are aligned in terms of adopting the strategy and framework that is necessary to be ESG compliant. And so what basically would this cost us in terms of the benefits and the objectives and the positive impacts of being ESG compliant? We would start by defining, first of all, the place of growth and innovation. So if we do understand as an organization the role that we play in catalyzing growth and innovation around our environment, then we must also make ourselves ready for adoption. What basically is the reason why ESG is critical is a foundation to start this discussion. And if we pull back and start to look into that, we must have to define that global organizations all over the world are beginning to look to making investments in organizations that are ESG compliant and have demonstrated the adoption of systems, framework, practice, and principles of ESG. Why are they looking to do that? They're looking to do that because they want to put their money in the organizations that have built responsibility and demonstrated ethical practices, and more importantly, are also supporting people and the society where they operate. So if this is very important and it's become a global practice, then local organizations across Nigeria and Africa as a whole must definitely have to align to that. And so if we have to align to that, we have to be able to keep ourselves in terms of the organization ready for adoption and compliance in order to foster the growth and innovation required.
Right, and you did mention, investors there looking to companies that are ESG compliant. Yeah. Do you think the investors would forgive, companies that cannot fully comply, due to political tension that we're seeing?
Well, I do not. Investors already have their systems and framework. They are not going to waive their expectations as a result of tensions and as a result of political crisis. Otherwise, investors fund funds that belong to people. So you're not going to ruin all of those investments out of, but there are so many other systems and structures supporting politics and the climate, while investors would look at favorable return on investment. But what's more interesting to speak about, which is really very critical, is the fact that organizations are beginning to look at especially Africa, opportunities in climate change, green funds. They're also looking at impact investment. And so they are looking to see how, in Africa, for instance, where are those organizations and individuals that are creating innovation, say around healthcare, green tech, Afritech, agri-tech. Why? Because there is the need to stimulate growth in those industries and sectors so that we can create employment, drive social changes, drive social needs, meet the needs of individuals, the society at large, and build solid, stable economies. So if we take away the political crisis out of space, there's the need to invest and focus on growing and catalyzing growth around all of these areas: healthcare and fintech, technology, renewable energy. All of those will consistently foster growth, both for individuals, the society at large, and the world to be a better place.
Right, and definitely you want to see businesses grow, because that will have an impact,
a ripple effect.
A ripple effect for the economy. So talk to me about what you're seeing, when it comes to ESG and most of these investors helping businesses grow in Africa.
Okay, so global investors, a good number of them work through local fund managers, and so the expectation is that the capital banks or the investment banks or the investment platforms are also supporting to create education and awareness to the organizations that they are giving this fund, because it's the role of everybody to remain and focused on sustainability and then, of course, ethical practices that will keep the organization strong. So how are they therefore supporting? They're supporting through education, training, and that's where FITC comes there. FITC has set up a Sustainability and ESG Institute, where we are able to help organizations who do not understand this practice or do not have the strategies and framework to build the solid strategies and frameworks, both in terms of defining and designing how they would play around ESG, defining the sort of framework that would run them, defining where, as organizations, they will put money and fund in driving social change, defining also how they can track, monitor, and report, because global institutions are looking to see reports of the investments made, of the work done, of the community engagement done. Many desire to do this, but they have no clue how to go about it. And that's where FITC comes to play. We provide knowledge, education, consistently supporting organizations, from organizations quoted on the capital market to even small businesses and enterprises who must show and demonstrate that they are sustainability and ESG compliant. And so we consistently create the knowledge and education, and also for leadership at the board level, to see that board directors understand the role of ESG in equipping their organizations to be able to attract international funds. Because if the organizations locally are not equipped, they will definitely not be able to access those funds. So it's not for investors to be sympathetic because funds belong to other people, but it's for us at FITC to work collaboratively with these organizations and institutions to keep themselves ready, equipped, and positioned to be able to access the funds. And then it comes back to the continent, because fund comes back to the continent. We make investments in the right industries and the right sectors, catalyze and stimulate the sort of growth and innovation that is required, and reporting is clear. So it's such a cycle, and it's such a great thing for everyone.
Yeah, quite a huge cycle.
Good cycle
definitely with an impact, that we see. But thank you so much. It was great having this conversation with you, Dr. Chizo Malaysia. This is the MD, CEO, FITC. It was great having you.
Thank you. But do remember also, if you have not, because we'd love to see you there, Ladi, the ESG conference is coming up sometime this week, and we expect that every single person should want to be a part of that conference. The conference will attract leaders from all over the world, diverse practice, diverse background, to speak about sustainability and ESG. It's not only a platform to understand this much more, but to also integrate, meet other leaders, and know what other people are doing.
Right.
It's going to be available physical and virtual. So whichever one you want to play, we're happy to extend the knowledge.
We're definitely looking out for that. Thank you so much for joining us today.
Thank you. Thank you.
All right, we're going to find out what's happening in a global space in a moment, right after this break. We know there's so much happening and the markets are reacting. That's in a moment. Just stay with us. Straight to to the global space now. We have Will Ibong with the details. It's great to have you. Will, I don't know if it's just me, but I can imagine investors just rolling, wondering what to expect. You know, for most of these economies, this week has been quite the hot weekend.
Yes, the hot weekend, especially with geopolitical tensions and oil, you know, the Strait of Hormuz. That is actually something investors are keeping an eye out for. Oil prices are skyrocketing. You know, investors are thinking, should we buy, sell? You know, those are things that actually shape, you know, the markets. Right. And other economic events are definitely happening, which I'm going to go straight into it right now. We see early PMI survey data is coming out for the US, US, Eurozone, UK, Japan, Australia, and India. They're providing, eagerly providing those insights that investors are waiting for that will shape economic trends, business confidence in June. Data has been collected as ongoing tariff uncertainty has been exacerbated by the escalating tensions in the Middle East. Now, this is coming ahead of the uncertainty in tariff deadline, which is early July. How businesses have positioned themselves and performed across these economies will be eagerly assessed with the flash data, which is going to be released today. Now, besides the PMI, we have a series of economic data also anticipated in Europe. Germany's flash PMI will also be coming out, and this will provide insights into business confidence via the future output index ahead of the release of additional sentiment indicators. Also, in Japan, the BOJ is going to be releasing a summary of opinions. You know, last week they held interest rates. We'll see what they bring out for us this week. And also, US, we're going to be getting the final reading for Q1 GDP and May's core PCE price index. Also, in the UK, first quarter GDP numbers will also be refreshed this week on Friday. But still keeping an eye, what to be keeping an eye on is the oil market. The US has urged China to stop Iran from closing the Strait of Hormuz, a vital global oil route. Secretary of State Marco Rubio said such action would be economic suicide for Iran, which relies on the strait to export oil mostly to China. Iran's parliament has backed the idea, but the final decision lies with its National Security Council. Rubio said any move to block the strait would trigger a strong global response. Analysts, however, warn a closure could send oil prices soaring above $100 and disrupt shipping for weeks, despite the Gulf. Now, the U.S. is pushing NATO allies to raise defense spending to 5% of GDP, up from the long-standing 2% target. Some nations support the move, while others still fall short. Now, the proposed 5% includes 3.5% for military needs and 1.5% for security infrastructure like cyber defense. President Trump and U.S. officials want firm plans, not vague pledges. With wars in the Ukraine and Middle East, this year's summit in The Hague is seen as critical, but differences over spending could spark tensions among members. But to give us a breakdown, especially for the UK and maybe the European countries, London correspondent Juliana Olainka joining us from London. Juliana, good morning. It's good to have you on the show.
Good morning, Will.
Juliana, the U.S. is demanding NATO members have 5% of their GDP. You see, some are on board, others not even close to the 2% benchmark. Can these allies afford the 5%?
Good question, Will, and it's a bold demand. I think Washington knows it too, but as you've been discussing, there's so much going on geopolitically that I think this is going to be the main talking point. Now, the United States, as you quite rightly said, is calling on its NATO allies to commit to this spending of up to 5% of GDP on defense, and this is going to dominate discussions at tomorrow's upcoming NATO summit in The Hague. Now, as we know, this push is coming as the US is warning that the alliance's posture is inadequate. And this is not just now. This is a discussion that began 5-6 years ago when Trump first got the keys to the White House. The only difference now is today's threats seem to be even more toxic. We've got Russia's war in Ukraine, and of course the Iranian-backed militias in the Middle East are becoming, I would say, quite frightening. The reality is that most countries, including the UK, don't meet the existing 2% target. I think there's only a few of them, including US, Poland and Estonia. And I suppose we're just going to have to wait and see about the trade-offs and what the talking points are going to be tomorrow. But it's an urgent request.
Definitely urgent. But let's just assume for a moment that they do agree to this hike in defense spending. Can the European defense industries that we have currently really ramp up enough while the U.S. shift their focus to Asia?
I think that's a really important question and something that, they're going to have to scratch their head and find a resolution to, because even with the political will, Europe's industrial capacity is still catching up. This morning, for example, Keir Starmer, the UK Prime Minister, he's announcing slashes of energy costs to huge energy-intensive manufacturing companies in the UK, just so that they can continue to survive. And those are the discussions that are taking place in Europe about the defence industry. I think countries like Germany and France have already launched multi-year procurement drives for ammunition, drones and missile systems. And here in the UK, we've had lots of discussions about the fact that the British Army could run out of ammunition in a matter of days if we were caught up in this conflict with Iran. So really interesting discussion, and I think there is going to have to be some sort of strategic pivot, which I'm sure is going to be discussed in the Netherlands over the next couple of days.
Well, just before we let you go, Juliana, we know that you mentioned the UK Prime Minister, Keir Starmer, is really juggling with a lot of fiscal pressures right now, and we've seen him proposing a 3% budget hike by 2030s. Do you think, is this ground for support, resistance, or is just wait and see how it goes, because he has not really proposed a specific timeline for this?
I think at the moment the UK is maintaining credibility within NATO, ramping up slowly, leaving the door open for deeper investment if the global environment deteriorates further. But let's be fair, as you quite rightly said, we've got a lot of domestic fiscal pressures. And I think in terms of public support, and that's exactly what the Prime Minister needs, public support, not support from Donald Trump. I think it's just not there. I think Britain support Ukraine and NATO. They're becoming very weary of large new defence commitments in the Middle East. So I think, there's a delicate balancing act. I'm sure you'll remember we had that coalition of the willing, that summit, where he gathered European leaders to Lancaster House a couple of weeks ago. So the momentum is there, but it's the money. You can have the momentum, Will, but if you haven't got the money, the stuff stays in the online basket, doesn't it? But let's see what happens over the next couple of days. But certainly, geopolitical threats are a major cause for concern for European leaders.
Yes, because you know that the UK currently spends about 2.3% of their budget on defense already, and this 3% is already an ambitious one for them. So 5%, wait and see how that goes. Thank you so much, Juliana Olayinka, for always sharing your great perspective on the show.
Thanks, Will.
So let's look now to Bitcoin. Bitcoin briefly dipped below $99,000 over the weekend after U.S. strikes on Iran and fears of rising inflation rattled global markets. Other cryptocurrencies like Ether and Solana also dropped sharply. Iran's threat to block the Strait of Hormuz pushed oil prices and inflation concerns higher, prompting traders to exit risk assets. Ladi.
Right. That's it. That's the downside when you're an asset class that trades over the weekend. You react immediately. Thank you so much, Will, there, for giving us the details. And we'll give you more on what's playing out with most of those markets that we track. That's at 1 p.m. on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.